Good morning to everybody in attendance here at the Orleans, and to everyone joining by Zoom on the camera in the back. Welcome to the NAIOP Southern Nevada Breakfast Program. I am Steve Niger, who apparently can't quiet the room like Ed Vance can. I have the privilege of serving as your chapter president this year. We have over 325 RSVPs in person this morning, probably more that paid at the door, so welcome this morning. I want to take a moment to recognize our UNLV students attending today. If you're a student, please stand. Any UNLV students back here in the corner? There they are. Welcome to NAIOP this morning. Please take your time to introduce yourself to any of the students in the room today wearing a bright green ribbon on their name tag after the program. Thank you to our student sponsor, Heller Companies, that make sure that no student ever has to pay for their breakfast this morning. In more news about UNLV, the Leeds Center for Real Estate is excited to host their annual Real Estate Career Expo on Thursday, March 26th. They'd like to maximize opportunities for both students and NAIOP members. If you are interested in participating in the Career Expo this year at UNLV, please contact Paul Chaffee. Paul, you're here somewhere, aren't you? Paul's right there in the back, blue jacket. I'm going to have some coffee while people continue talking. Hey guys, let's get the program started. Let's get some chapter business and exciting news out of the way so that we can get on with the great program we have planned. First of all, CLLR. Earlier this month, some of our chapter leaders went to Washington, D.C. for NAIOP's annual chapter leadership and legislative retreat, bringing together leaders from the 52 chapters across North America. The retreat provides opportunities to learn from our peers across the country and meet with our federal delegation on Capitol Hill. You'll be happy to know that our chapter took the first steps in gathering the chapters from across the western United States to initiate these conversations about land policy. If you were to look on a map, the western United States is mostly owned by the federal government and the eastern United States is not. So we're trying to get creative and bring people together on that conversation and get productive. They also give out national awards during a ceremony at CLLR, and we do our best to bring at least one trophy home to you every year. This year, our past president, Matthew Hoyt, won the Outstanding Leadership by a Chapter President for the large chapter category. Congratulations, Matt. I think he's here somewhere. More really big news. Last year, the board of directors redefined the role of our chapter's executive director to find someone to help our chapter take on the challenges of the future on behalf of our members. Someone able to ensure that NAIOP continues to be the great organization we are today, and also someone capable of taking our government affairs and advocacy efforts for the entire commercial real estate development industry to the next level. Well, in case you missed the press release, I am so excited to inform you that we have found that person. Jamie Schwartz has joined NAIOP from UNLV, where she was the Director of Business and Industry Engagement for the UNLV Office of Economic Development. She is a homegrown rock star, and I think we all couldn't be more excited about her joining the team. Jamie will work in partnership with our board of directors and president to advance strategic initiatives and elevate the chapter's presence in our community. And don't worry, Katrina's not going anywhere. Jamie has already been and will continue to work closely with the legend that is Katrina Bruce and the entire alternative management team. Everyone, please welcome Jamie Schwartz.
Thank you, Steve, and thank you guys for such a generous welcome. It is truly an honor to step into this role with an organization that I have respected for many years and a community that I have always thought was so strong. NAIOP plays a vital role in shaping thoughtful growth, strong partnerships, and a healthy future for Southern Nevada. And my focus this year is very simple. It's to listen, to strengthen relationships, to support our members, and to help elevate the voice and the impact of this chapter. I'm really excited to work alongside this incredible board, our members, and of course, Katrina and the alternative management team. So thank you guys for the warm reception, and I'm really thrilled to be here.
Thank you very much, and thank you to everyone involved, all the volunteers on the subcommittee that created, revised, and sought out this role and found Jamie. A whole subcommittee of volunteers made that happen, so I'm very appreciative for our volunteers. Let's take a moment to honor our current President's Circle sponsors. They are a critical component to the success of our chapter. This year, we have 4 platinum sponsors. Special thank you to each one. Cox Business, who has supported our chapter for 22 years. Lincoln, since 2022. Martin Harris Construction, since 2001. And Schnitzer Properties, since 2000. Thank you, our platinums. We also want to thank our 11 golds, Burke Construction Group, Clark County Community and Economic Development, EBS Realty Partners, Heller Companies, Howard Hughes, Kim Lee Horn, Majestic Realty, Prologis, Southern Nevada Water Authority, UES, and Unforgettable Coatings. Thank you, golds. Now on the screens to my sides, you can see our silver, bronze, and copper level sponsors. We have many of them, and without all of them, we could not make this chapter do what it does. Grateful for all of you. We're still taking PC applications. It's an ambitious year with still more accomplishments and news on the way. So thank you very much, PC sponsors. All right, a couple more things, and we can get started. Each month, we like to recognize our new members. If you are a new member, please stand and welcome to NAIOP. Any new members? There we go. Thank you very much. Welcome to the room. And if you see them wearing, what are you wearing, red ribbons on your name tags? Say hello and make them feel welcome, please. It's an intimidating room on your first time. NAIOP Southern Nevada is currently 798 members strong and ranks in the top 7 for NAIOP chapters nationally, which is impressive for our tiny little town. If you are not a NAIOP member, you should be. We are the leading organization for commercial real estate development in Southern Nevada, and we are only that way because we've got great members who do great things. I invite any non-members to get up or get online and become part of this incredible group. You can go to the registration table, see the website, you can join all over the place. Now, thank you to our 2026 breakfast sponsors, and thank you to our Wi-Fi sponsor, Lincoln Property Group. Today's sponsor, special thank you to today's sponsor, Schnitzer Properties, who is also one of our platinum sponsors. I'd like to introduce Jalen Hawkins, portfolio manager for Schnitzer Properties, who is a DLI graduate and also the chair of our programs committee who puts on these breakfasts. Welcome to the stage.
Okay. Thank you for that introduction, Steve. So good morning, everyone. My name is Jalen Hawkins, and as Steve said, I'm a portfolio manager here for Schnitzer Properties in Vegas. We're fortunate to be known by most of you in this room, but for those of you who don't know who we are, Schnitzer Properties is a family-owned real estate investment and development company and is one of the top 10 private real estate owners in the West. We were established in 1950 in Portland, Oregon, and our owner, Jordan Schnitzer, has helped grow Schnitzer Properties to own and operate over 33 million square feet of property, primarily focused on industrial spaces for small and mid-sized manufacturers, distributors, and family service providers. The company manages regional offices in Seattle, Portland, the San Francisco Bay Area, Sacramento, San Diego, Las Vegas, Phoenix, and Tucson. This breaks down to over 200 plus properties, over 4,500 tenants, and a team of over 300 real estate professionals. Here in Vegas, our team runs 55 members deep, and we own and operate our portfolio of more than 11 million square feet, made up of primarily multi-tenant industrial. We're excited to continue expansion in Vegas with 2 projects that just got delivered, one in the Southwest and one in North Las Vegas, and we have another one that's set to be delivered soon in the Southwest near Dean Martin. With a portfolio of this size, it's organizations like NAIOP that really help keep our feet on the ground. NAIOP consistently provides access to a robust network of industry professionals to market insights and advocacy efforts that help shape local real estate policies. And it's easy to see why our team is a platinum sponsor. We have 11 members locally within the organization, and a handful of us are directly involved. Reed Gottesman being a past president, Amanda McCauley being on the NAIOP Board of Directors, and myself being a DLI grad and the chair of the programs committee. So thank you all for giving me the opportunity to speak today. As we look ahead, let's continue to collaborate, innovate, and drive growth in Southern Nevada's commercial real estate world. Thank you.
Good job, Jalen. All right. As we kick this program off, I just want to say thank you to the Programs Committee for putting together the best programs in Southern Nevada. Reminder that for all of you here in the room, we have a Q&A session at the end of the program for our in-person attendees. There are notepads, pens, and paper at tables for you to write down questions, which will be collected by Dan Tuntland. And if you don't know him, it's because you've literally never been here before. You'll see him walking around. Q&A starts at 9 a.m. and our program concludes at 9:15. I am excited for our program today, Developers Roundtable, Building Through the Cycle, and I have the pleasure of introducing today's moderator, Suzette LaGrange, Principal and Managing Director of Avison Young. Suzette is also a past NAIOP board member and active on the Programs Committee. She has more than 30 years of commercial real estate brokerage experience in Southern Nevada. She's a Las Vegas native, like many of us in the room. She's known for her deep market knowledge, strategic insight, and ability to connect the dots across office, industrial, land, and investment cells. As today's moderator, Suzette brings a unique perspective shaped by decades of transaction experience in Southern Nevada, industry leadership, and a passion for fostering thoughtful, forward-looking conversations within our commercial real estate community. Welcome to the stage, Suzette.
Thank you. Far longer than it should have been, but thank you all for having me. This is really a lot of fun. NAIOP is just so near and dear to my heart over my entire career, so it's fun to be up here in a different capacity, and really exciting to moderate this panel of amazing developers here in our community. So first I want to welcome up to the stage Andrew Dunn. He brings an entrepreneurial and yield-focused approach to development shaped by his leadership roles with VAC Development and WG Group. With experience spanning acquisitions, underwriting, land development, leasing, financing, and dispositions, he focuses on structuring projects with multiple exit strategies to create sustainable value across the Southwest and Mountain West. From transforming underutilized assets into high-performing investments to expanding into new markets through innovative capital structures, Andrew offers a hands-on, growth-oriented perspective on today's retail and industrial development landscape. Welcome, Andrew.
Thank you.
Thank you. Next, I want to bring up Alex Hancock. He serves as the Senior Vice President, National Sales and Leasing at Howard Hughes, where he leads enterprise-wide commercial pursuits and oversees office leasing across the company's national portfolio. Alex plays a central role in shaping leasing strategy, major transactions, and commercial positioning for some of the country's most complex mixed-use, sports-anchored, and master plan developments. Before joining Hughes, Alex was nationally ranked top-producing broker, leading over 12 million square feet of office leasing and closing $750 million plus in transactions. His background bridges brokerage, execution, and owner-operator leadership, giving him a practical, market-driven perspective on office demand, development strategy, and value creation in a rapidly evolving commercial landscape. Welcome. Thanks for joining us, all the way from the Houston area. And one of our favorites in all of NAIOP, Rod Martin with Majestic Realty. Come on up. Rod Martin joined Majestic Realty in 1992 and serves as Senior Vice President and Director of Development in Las Vegas, where he oversees development, leasing, and asset management across Southern Nevada. As Senior Development Partner, Rod has led the delivery and ownership of nearly 8 million square feet of industrial and office projects in the southwest submarket of Southern Nevada, helping shape the valley's logistics and business landscape. A graduate of Arizona State University's W.P. Carey School of Business, Rod brings decades of hands-on development expertise and long-term market perspective to today's industrial conversation. Thanks, Rod, for joining us.
You're very welcome.
Kind of had to twist his arm because he's a tough one to catch for these conversations, but I appreciate you. Thank you. Gentlemen, thanks for joining us. What a world we're living in here in Southern Nevada. I appreciate you coming to talk to us. Let's start out. We went over through introductions, but give us a little bit of background about the product that you develop in the area of town, your recent developments, and upcoming pipeline. Tell us what you're up to here in Southern Nevada. Andrew, why don't you start?
Yeah, so we just finished up a neighborhood strip center off Rainbow and Aquendo, more focused on the multi-tenant retail sector. We're focused in the Southwest and Mountain West. Headquartered here, we're building shallow bay infill industrial with the IndyCap guys down in Phoenix, some larger big box stuff up in Reno, and then we're focusing more on the repositioning of strip centers and neighborhood centers kind of throughout the Southwest and Mountain West in the middle market space, like that 5 to 50 million.
Wonderful, thank you.
So Howard Hughes is up to a lot of things. Under my purview, though, is the office leasing, the office portfolio. We own about 1 million square feet in Summerlin, spanning 5 assets. And so I oversee the office leasing team of that. Howard Hughes is obviously up to a lot on the residential side as well as the retail side, but I'm kind of representing the interests of the office portfolio.
Good morning, Suzette.
Good morning.
Thank you very much for having us here. Can everybody hear me okay? Even way in the back? All right, Jim Guerin. Rod Martin with Majestic Realty. Majestic is a national developer, privately owned, headquartered in Southern California, founded back in 1948. The bulk of the portfolio of just over 90 million square feet remains with industrial. Here in Las Vegas, we've got, as Suzette mentioned, about 8 million square feet of industrial. We also do have a little bit of office and 1 retail center. No, I take that back, 2 retail centers. We've concentrated in the southwest submarket of Las Vegas. Our holdings all, quite frankly, are within a 2-mile radius of my office. They're at Jones and the 215 freeway. Gives us tremendous insight as to that submarket, having the 175 plus tenants that we have. It really gives us a direction as to when to build, what to build, and just general economic, I guess, conditions out there. I'll probably stop now because I think, what was it Kyle said last time, limit your answers to 90 seconds, and then otherwise people stop tuning out and looking at their phones. So I'll let you get back to it.
No. I think that, so you're focusing in the Southwest. Everybody is talking about Apex for industrial, and Apex is high vacancy, big spaces. You're focused in the Southwest. So we're taking a little bit of a different turn here with this. You're in the Southwest. The industrial market in the Southwest is quite different than Apex. Can you talk a little bit about that?
I think it's quite different just because the land constraint of the Southwest. I think the Southwest overall, and I'm sure one of the brokerage houses here will, and Suzette, you probably know, about 42 million square feet of industrial in the Southwest. And if you take out that which is owner occupied, you're probably down closer to 30 million square feet. We happen to have, as we mentioned, a little over 7.5 million square feet. So it's nearly 25% of the Southwest submarket. It gives us great insight as to what's happening there. With the land constraints, it's very difficult to find large parcels to build. 5-acre parcels are of decent size, but quite frankly, it's a troubling site dimensionally to lay out industrial buildings. Apex, it's the other end of the spectrum, wherein there's a lot of land still in Apex. Apex is going to fill up very quickly. It's the only place where there is available land. I look back, and although we've concentrated in the Southwest submarket, I still kick myself for missing opportunities. We could have JV'd a deal with Thomas & Mack up in the Speedway area for a very low price. Missed that one. Missed out on Voss Breda, Colony Capital's land that Prologis picked up. Probably had an opportunity to do something with Dan Tutland up there in Apex. Probably missed the boat on that as well, but somebody else is going to do very well on that land. So Apex, it has its time coming. And I think when I see general conditions here in Las Vegas, throughout Las Vegas, starting to improve, and as we're churning through what happens anytime a real estate cycle has low interest rates, low vacancy, everybody overbuilds, and we just need to chew through that inventory, and everything will be okay.
Yeah. Eventually, yeah, we'll get there. No, I think this year.
Quicker than you think.
I think that even this
Maybe
year,
next
it's
year.
gonna stay. Maybe next year. Maybe next year. Alex, talk about the state of the office market from your perspective, and how do you feel about it, and what drives that decision or that thought process?
Yeah, I think the state of the office market is very strong right now. There are some headline articles that may portray something otherwise, but that's more on kind of a macro basis. If you actually drill down on the numbers and the rates and the rent growth and all of that, it's actually performing quite well. If you look at the market as a whole, Class A, Class B, close to 60 million square feet. The Class A product is 11 million square feet, and it's 10% vacant. I mean, round numbers. I'm sure someone will fact check me, but round numbers, about 10% vacant. Everywhere else in the country, large cities, it's like 20% vacant. That's kind of the new norm right now. So it continues to perform very well there. The other thing that we look at is year-over-year rent growth. Year-over-year rent growth in the Las Vegas market is over 4%. When you compare this to, like I looked this morning, Los Angeles is actually negative 50 basis points.
Wow.
So when you look at kind of rent growth, the rent growth is strong. Vacancy is low. Now, the counter argument to that is that it is a relatively finite market. And to Rod's point, that is because it's a finite market, you can kind of capitalize on I would say the general trends in the market, the demand, kind of the pure economic supply-demand drivers, as opposed to just is paper cheap? Is it can we just build because we can get a cheap loan or a construction loan? So generally speaking, I think the market is very strong. I think it will continue to perform well. The Class B stuff is the same vacancy as Class A, which is good. It actually had a slightly higher rent growth. So we're very optimistic if we could just get away from some of these kind of rate challenges that we have, interest rate challenges.
Yeah, fantastic. And Andrew, how do you see the state of the market on the retail side? You're on this panel kind of from a different point of view, where these gentlemen have, Rod's got land leases he can build on. He's got some really nice sites in the Southwest. Doesn't have to go out and scour the dirt. Not that you wouldn't, but you don't. You got some nice sites. Alex is sitting on land that Howard Hughes has owned for years. You're out there trying to find the deals on the land. How do you feel about the retail market, and how do you make this happen? And what do you look at when you're starting to redevelop? Because you do redevelopment,
yeah,
and also develop some of these retail sites.
Okay, so I'll unpack that.
Sorry, that's a really long question.
So I think the current state of the retail market is bifurcating into the K economy. So you're seeing a catering to the affluent, where the top 10% of earners make up 50% of consuming right now. So you're seeing the middle get middled out, more or less. So capital's really attracted to grocery anchored centers, affluent demographics, above 100K household incomes, or they're dedicated to more or less the discount, like TJ Maxx, DD's types of centers to service where the consumer's kind of trading down. So you're either going up or down, and I think it's very hard to accommodate that as a developer in this current market. Like for us, we don't sit on a treasure trove of cash. We go out, we raise money from friends and family, we go find an institutional equity partner, bring in a family office, go to a bank, get a loan. And so in the current land side of the development market for retail, it's very challenging. We're definitely seeing build-to-suits take a halt. Ground leases are taking a halt. We've definitely, I feel like, hit that occupancy cost threshold on a lot of the retail real estate. And you're seeing freestanding retail have less than a 1% vacancy factor in the market. You're seeing retail rents hit all-time highs. I think I just saw the district sign a $65 square foot lease. I see Uncommon signing leases in the $60 foot range. We've been signing leases in the plus $50 foot range. That wasn't a thing, 5 years ago.
Right.
So when we built our recent strip center, we pro forma'd like a rent of $39, $40 a foot. And then we ended up getting an average rent of $50. So we broke ground in 2024, stabilized in 2025, have that strip center out on the market, sold off our pads, but we've been hearing the stress from tenants like Starbucks, some of the other drive-through brands. And so for us, it's just, where do you find that land seller who's willing to give you that accommodation to get your entitlements, and if you're really lucky, get you to permit so you can go get that cash, because I think the entitlement period has doubled, the permit period has doubled. We're seeing a disconnect more or less in the public and private sector on timing expectations, but the retail market's very healthy. We're seeing occupancy costs managed by all these tenants, and then definitely a deeper focus on, ethnic targeted demographics, like in Chinatown, where they're seeing, I think, 3 new centers go under development, and then you're seeing tenants like Mariana's Market and other Mexican grocers really kind of thrive as, Las Vegas is now almost, I believe, a third Hispanic. And so I think you got to lean into that, lean into the affluent, or lean into the lower demographic, but picking the middle, you're going to get in a tight spot.
Yeah.
So, yeah.
How are you managing your capital stack? We talked a little bit on the phone about, what your partnerships look like. Can you kind of lift the hood, tell us what that looks like? How do you make these deals pencil?
Lipstick and bubble gum. I think at the end of the day, so on that strip center, we took down that land in July of 22, did a bank loan, we put up our own cash, and then when we got to a permit, okay, go get the GMP with the contractor. We're going out to the capital markets. No banks would give us loans because we had no leases on the inline retail. But what we saw was that the inline retail submarket in the Southwest had a 2.5% vacancy rate. So we're like, this market is tight. The traffic on the street is 60,000 cars a day. The demographics are good, just like kind of Rod was saying. And Alex, the Southwest and kind of Summerlin's growing. That's where kind of all the money and just development's going. So we're like, hey, this will work. And nobody would give us money. So we went out and we got a loan at 80%, at 11% from a debt fund called AGP Capital in Summerlin. And then nobody would give us equity because they didn't believe we didn't have the leases, even though we had leases from a gas station, an auto shop, Starbucks, and then another QSR. And so what I did was, all right, how about we just guarantee the return? And I said, hey, let's go give our investors a 22% preferred return for the term of their investment. And it ended up working out for us, and now we own that strip center with no cash, and all of our investors are paid out. So
That's great.
I think it's just you have to bob and weave. We've had a couple more stories like that, throwing in some pref equity, levering up or levering down. You have to accommodate to what's in the news, who has money, and you have to kind of chase what the money wants today. It doesn't matter if you think it's a good deal, it's what does the broader market think is a good deal to give you money for it. So, yeah.
But it can be done. And I think you said that project was like a 38% IRR.
Yeah, if we would have gotten traditional equity more on the JV side instead of fixing the return at 22%, those investors would have clipped a 38 IRR.
That's great.
Yeah,
That's wonderful.
So it was good.
Andrew, where is that project?
Off Rainbow and Aquendo.
Rainbow Naquendo. Yeah.
East to west side?
East.
Got it.
And they have Carmine's Pizza going in, and so if you're a native Las Vegan, you know about Carmine's Pizza,
Yep.
and it's the best in Las
100%.
Vegas. So anyway, I digress. All right, industrial. Let's go back to Rod here real quick. Demand versus discipline. Demand remains strong, but development has clearly become more disciplined. What separates projects from moving forward from those that are stalled? And talk a little bit about tenant commitment. What do the tenants look like today? You had also mentioned about losing a couple of tenants.
Yeah, we lost a couple.
Recently, and why?
They didn't
In
run
this
the business.
market.
They didn't run. I think the kind of the weak have fallen by the wayside. Finally, it's an economy that you have to perform well. You have to operate your business efficiently. We have lost 4 tenants over the course of the last probably 16 months. I think prior to that, we hadn't lost a tenant for probably 4 years. When I look at those 4 tenants that we've lost, 2 of them have just shut their doors here in Las Vegas, and the other 2 retracted their size by about 50%. So it's one of those things that is going to happen. It's not a market where everybody is going to thrive. One of the things that I pay very close attention to within our portfolio is delinquencies, and we're not seeing any delinquencies. Frankly, I haven't seen any delinquencies since people elected not to pay their rent unilaterally for 4 months during the 2020 year. But since then, delinquencies are down, and that's a healthy predictor of how businesses are doing. I think what we're seeing within the existing portfolio, we're no longer in a period wherein If you think you need a little bit of growth, you're going to go ahead and just pull the trigger and take more space. People are going to be much more measured today, and they're waiting until they absolutely need to grow, and they're looking for stopgap measures. They'll take short-term leases, shorter-term extensions. But the market is turning. I think probably when you first asked me to be on this panel, if you would have asked me my outlook on the market, I'd say I'm a little bit apprehensive. I'm not all that confident just yet. I feel a lot better today. It's not to say next week I feel rotten again, but
Yeah. I was listening to a panel yesterday, and it was a lot of brokers on the panel, and it echoes what we experienced in January at Avison Young. January was an amazing month. Like, it was amazing. We didn't expect it, at least I didn't. And so I think that was sort of opening the door for the rest of the year, where activity really came back with, I won't say a vengeance, but definitely great activity in
And I think
January.
I'm happy that I'm in Las Vegas. And I think Alex hit the really nail on the head with respect to rent growth.
Yeah.
What we've seen here, I've been in Vegas for 32 years, and probably we've seen close to an average 5% rent growth over that term. You know, inflation's probably mid-twos. You're not going to see that in any other market. And so, you know, our investments here are, you know, really generational investments we're going to build and we're going to hold because we truly believe in Las Vegas.
Yeah.
And, you know, I think that's why I maintain a very bullish attitude, recognizing that we're going to have some downturns, but we're in it for the long haul.
Yeah. So you mentioned tenants are more likely to do shorter-term leases. That's probably not the best advice right now if you're seeing rent growth continuing to grow. And do you want to, as a landlord, do you want to do short-term leases? I mean, do you want to do long-term leases, or does it really matter?
It depends. On a new project, obviously, you want to have term for your permanent loan. We'll do shorter-term renewals if that's. As a landlord, we don't try to bully anybody, and we want to accommodate what tenants' needs are for their space. If they're short-term, we're going to do the best to accommodate that. We know that you know, we're going to still be around, and a little bit more work for all of us to renew it on a 1-year or 2-year basis, but you do what you need to do.
Gotcha. Alex, let's talk a little bit about office tenants and what it takes to get an office tenant into a new suite, into a shell space. Can you tell us a little bit about the tenant improvement process and what your experience has been here in Southern Nevada, what it takes to get a deal done?
Yeah, so first I'd echo the comment that I guess when we first decided to get on the panel, or agreed to, the market was slightly different than it feels it is 30, 45 days later. Keitha Anderson, who's here, who runs the office leasing portfolio in Summerlin, I had to explain to her yesterday the term sandbagging because a lot of leases got signed in January and February of this year. And there's a lot of good activity. As far as new construction, new tenants coming to new construction, it's expensive. It's expensive to build out space. We are very fortunate in Las Vegas and Southern Nevada that there hasn't been the same creep in concessions. You know, tenants looking for, you know, extremely heightened tenant improvement allowances as there are in other markets. And part of that's to Rod's point that if you're signing long-term leases, they're expecting these very heightened concession and TI packages. It has stayed relatively tempered here in Nevada, despite the fact, here in Las Vegas, despite the fact that construction pricing has gone up for tenants. I think that what we've seen and what our tenant coordination team has seen as well is that there just has to be a little bit more prudence. We have to actually strip kind of the layers back of some of the pricing to understand what's actually driving the pricing up. Once we do that, I think that there can be kind of a better fiduciary responsibility, and there's the ability to build out space still at modest levels. I think that what we experienced in COVID, post-COVID, was crazy. I was telling these two guys in the call that we had before this that we normalize this expression of like supply chain issues. I'm sure all of you guys have either heard that or used that excuse at some point in time. We normalize this kind of excuse of supply chain, and that's what we're seeing throughout kind of the whole contractor ecosystem is that, you know, there are supply chain issues. Once you start to dig into that, and you start to strip away the normalization of using those type of terms, you can actually get some, what I'd say is kind of prudence in some of that pricing. That being said, it's still high. We'd like to see it come down. we'd like to accommodate tenants moving into to new shell space without having to commit to 10-year terms and $100 in tenant improvement packages.
And even above and beyond, you're doing a 10-year term and giving them $100. They're still putting in another.
They're still putting in a significant investment.
$50 to $100.
And that's good. I mean, that's a good story to tell your lenders. That's a good story to tell folks that this is a long-term commitment they're making. And when a tenant invests $100 of their own money, $80 of their own money, they're committed to that space.
Yeah.
So yeah.
Have you seen pricing on your tenant improvements retract at all? Or is it anything going down? Are you seeing any economies of scale? Let's talk a little bit about that.
I wouldn't necessarily say economies of scale. I would say that there's flattening. And then, again, kind of going back to the prudence discussion, like once you actually start to get into it, I think that you can start to pull some of those levers. I think that, broadly speaking, kind of macroeconomics, and I'm sure I know there are a number of folks in the contractor business that are here would probably agree with me. This data center growth is crazy, and it's affecting everything along the supply chain. And so, everything from materials, but then also down to labor. When you have these data centers that are just like outsized returns, where they'll pay anything for labor, any type of margin for labor, you see general contractors and subcontractors start to reposition some of their labor to those kind of higher margin work. And so, whereas, there will be a normalization in the market, in labor, in trade labor. But I think that has had a broad macroeconomic effect on that supply chain.
It reminds me of back in early COVID when Amazon came in and they were just eating up industrial space all over the place. And like, we can't get trusses, we can't get all these materials, we can't get switchgear because they're taking them. Now the excuse is, I won't say it's an excuse. I mean,
no,
it's real. But it might be an excuse. I don't know. I love my contractors in the room. But now we're hearing it's the data centers now eating up all of the resources. And Rod, are you seeing that on your side of things? Is there still long lead times for switchgear and infrastructure major?
Yes, still 40 weeks for switchgear, down from 56, so it's a little bit better. The data centers, just because of the dearth of power around that's available, they're just, pedal to the metal, and they want to get up as quickly as possible because they recognize that if they don't, it's going to be a long, long wait until there's new power generation sources. So it's definitely impacting, everything that we're seeing out there. Here in Las Vegas, I don't think that I've seen that much of an impact with our local GCs and subcontractors here in town. I think that on the shell construction, quite frankly, I'd say that pricing's been pretty flat over the course of the last year plus. The last time we priced a project was March of last year, and we had all kinds of contingencies because that was just after Liberation Day, and we had contingencies for price escalations and so forth that never materialized.
I think that's a great point, the contingencies. After COVID, because we were in this period of such uncertainty, the contingencies were so high.
Absolutely.
You were contingencing your contingencies.
Yeah, you're exactly right. Everybody added contingencies.
Yeah, exactly. And now that normalization has certainly helped.
So that
Wait, does
leads.
that mean you had a deductive change order from your last contractor?
yeah, exactly.
So let's talk about construction costs and uncertainty. Andrew, how are you managing those contingencies, and where are you seeing the greatest risk during the development process?
I think beyond, once you get out of the dirt, I think obviously there's always something, but I think when you deliver these spaces, like on the development side, we're delivering them typically on a gray shell condition. And what we've seen, kind of in the supply chain issue and kind of unpacking it, not making an excuse like you were saying, is that we've seen on a restaurant, for example, in 2020, kind of like pre-COVID, hoods for a restaurant are 3x from what they were. Grease traps are almost 4x of what they were, but rents haven't gone up at the same scale. So little points like on the mechanical side or some of the infrastructure points inside these spaces have gone up an exorbitant amount, and it's really kind of hard to budget that. So you need a capital stack or a capital source where you have a base rent package and a base TI package that can, scale up and down and piece apart kind of what you're talking about. I think on the different side, and maybe it's more like office versus the industrial, we're seeing these tenants spend a lot more above our TI contribution. Like on that strip center we were telling you about, we budgeted a $65 a foot TI allowance. We ended up being at 90. Again, I got more in rent, but I had to spend more in TI to even get those tenants. If you're a retail developer or a retail landlord and you're trying to land a restaurant, you better be prepared to stroke that check to get that restaurant, because those tenants aren't willing to put in all that money now that the rent is, climbing to all-time highs. So I think you have to be prepared to stroke the check to get the tenant, and then to your point, these tenants are spending another $150 to $250 a foot minimum to get inside these spaces. And then when we look at these centers, the merchandising mix is really focused on, I don't want to say experiential because it's been kind of overused in our word, but essential service retail and just food and beverage. So I think when we look at a center, how do we get to a 40 to 50% F&B ratio to just kind of create a well-diversified mix? And then what we've seen with dentists take retail spaces, we are now seeing dermatology take spaces. We're seeing a huge influx of medtail, and instead of these medical office tenants staying in these medical office buildings, they're now going into retail centers. Yeah. So I think again, we all know it, what medical TIs kind of cost on an office side. We're starting to see it in retail. I just think the difference is I think we have a higher rate on some of our spaces than what you typically see in office. So that's kind of what we're seeing.
Is there an example you guys could give us where you've had to really value engineer or work with your with your design team, your architecture engineers, to kind of value or engineer yourself out of an issue, and where have they come in as a strategic partner for you guys? Anything you can point to on that?
I think you first look to your civil engineer. In the front end, the civil engineer can really make or break a project on a lot of different levels, not only in what they're able to determine with respect to balancing a site. They're going to be very involved with respect to procuring your utilities in a timely manner, really hand-walking the process through the public works process and entitlement process. So I think the civil engineer that you select is absolutely key. With the architectural, no, I mean, it's, you try to find that balance when it comes to industrial. You obviously are looking for functionality. At the same time, you're trying to balance that with site coverage and get your floor ratio area up. But that really is going to be site dependent as well. And again, a lot of that goes back to your civil engineering as to where you're going to have your loading to maximize what your efficiencies are on the site. So I would say much more so from the civil side than from the architectural side.
Yeah.
I would say we actually are focusing a little bit on the architectural side now as well, trying to get even in advance of that. We're the development team's designing a new office building in Summerlin right now, and what we did is basically said, let's work backwards a little bit. Let's try to figure out what we need to achieve from a revenue standpoint. We know what the metrics are, and we can. We know kind of where we need to be on a revenue side. So let's work backwards from that, understand the yield that we need to achieve on it, and then engage it. Usually what you do is have an architect design a building and then go to the general contractors and have them value engineer it. What the development team's doing this time is saying to the architect, let's value engineer that. So that maybe we're reducing our contingencies on contingencies by saying if the architect value engineers it and then we go to the contractors and value engineer it, we have a little bit more savings there. So again, just kind of applying it across the whole ecosystem of the design of the building, and our development team's working on that right now with an office building in downtown Summerlin.
That's a great point. Start with the budget in mind and then design backwards from that. Yeah. What about you, Andrew? Anything?
I think I'd kind of echo Alex, but I'd say you have to more or less bring your team into the fold earlier than later. And you kind of have to have your GC or your pre-construction team with, I completely echo what you're saying on the civil side of what you kind of see out in the field. So civil's key, architect's key, your general contractor's key. If you use an owner rep, that's key, and just kind of managing that expectation of the process. And again, to your point, keeping the budget in mind, but also understanding that you have to have adaptability. You can't just go out and say, hey, this is going to work today, because a building just doesn't say, hey, I'm going to go buy this piece of land and a building's going to go up next month. It's a several-year process down the road going through that entitlement. Again, God forbid a COVID happens or something else, you have to just have that adaptability. So I think what we're looking at is more making your space adaptable at all times, the best you can.
You opened up, both you and Rod opened up the entitlement box of worms.
Yeah.
Let's talk about the entitlement process here in Southern Nevada, guys. What has been your experience? How is it going? What can we do better? How do you manage it?
You've done a lot more of it than me, but I'll take a crack at it. I think one of the wildest things that happened to me was when we were going in, and the rounds of comments just kept getting longer and longer. It wasn't like 5 weeks, 4 weeks, 3 weeks, 2 weeks. It was 5 weeks, 4 weeks, 5 weeks, 6 weeks, 4 weeks. And then, like, okay, there wasn't, like, since COVID, everybody just kind of defaults behind their computers and Zoom or Teams, and nobody actually all comes together and let's have a meeting and sit down. And I think the largest, like, eye-opening experience to me was when we went to the water district, and I asked the girl working there, I was like, so how many projects did you have on your desk, like, pre-COVID? She's like, 5 to 7. And I was like, how much do you have on your desk today? 25. And I was like, okay, so you've almost 5 times the amount of projects. Like, I just feel like there needs to be more of a private-public partnership. Like up in Story County, we're building a 300,000-foot spec industrial building. We got our permit in 87 days from the time we submitted plans. And then we are allowed to have a third-party inspector go and inspect the concrete in the building. So that rapidly kind of moves everything up the chain. But
This is Tahoe Reno Industrial.
Yeah, Tahoe
up in
Reno Industrial Center.
That's incredible. Yeah, it'd be great. And that's because they third party that. They outsource it, the municipality.
Yeah, it's just, again, that private-public partnership.
Yeah.
I don't know where artificial intelligence can kind of play in the mix of, the database of plans or anything like that, but I think there just needs to be, for people like us, like in the current state of the land environment, a lot of the land ownership here that's outside of the federally owned land with the BLM, these guys usually want a 90-day transaction period. But my entitlement period can be anywhere from 9 to 15 months. And then, unless you want to go at risk with your civil engineering plans, it could be another 12 months after that. So by the time I go get a piece of dirt, submit a plan, and have the ability to break ground, it's anywhere from 24 to 30 months. That just doesn't, it's very hard to kind of manage unless you're just a cash buyer and kind of like you guys have done, or even Howard Hughes, where you kind of have a 10-year, 20-year kind of horizon cycle on your land holdings. So,
Yeah.
So I remember when Story County literally was over the county.
Yeah.
So now you're up to 87
So
days.
now you're at 87 days.
yeah.
But what we wouldn't give to have it be 87 days, right?
Yeah,
Here in
absolutely.
Southern Nevada.
So my opinion, based on experience, is I think that the planning process in Clark County takes too long. It's frustrating, just the backlog to wait for a meeting and then to have subsequent meetings. I would like to see them improve upon that. I know that at the higher levels, that's their objective as well. I think at the public works level, where I think they've much maligned for many, many years, again, at the higher levels, they are trying to get better, and I think they have gotten better. I'd like to see them continue in that direction. I think at the building department level, Building Shell, I think, does an exceptional job. They have never been the long lead item for us on any of our projects. I would like to see them improve their TI process, because that takes too long. Again, in the world of industrial, we may have a couple 100,000 square foot building and a 2,000 square foot TI, but we're not getting rent because the TI takes so long through the processing. I think that the utilities also take longer than we as developers would like. And I think we do recognize that there are a lot of challenges they have, particularly with power, but also with water and water rec. Again, I think here we've got the right collaborative environment within the senior level staff. I get very frustrated with more of the line staff, and there's nothing that frustrates me more than we've got 14 days, we've got 10 days, we've got 30 days, and know that nobody's trying to beat that time frame. Yeah.
Yeah, they'll take every bit of that, Alex, what about tenant improvement, the permitting process, and are you letting tenants roll with the construction, or are you keeping control of that? How are you getting tenants in? Because that's taking a really long time.
Yeah, I think on the office side, it's much better than on the retail side. We manage construction. Got a terrific tenant coordination team that manages construction, and then we also have a number of projects where it's self-managed by the tenant. I think, to Rod's point, it's all about dates. It's all about these time frames. Like 30 days doesn't mean 30 days. That's the outside date. And so including that, articulating that in leases and articulating that in a very collaborative environment with the tenant itself is utmost importance right now.
And Suzette, can I just interject that NAIOP is doing a fabulous job in setting these meetings with the building officials and the planning and public works officials. So everybody in this room should know that NAIOP really is prioritizing that as well. And again, very productive meetings, and I think that the will is there, and we just need to continue to work on it.
Yeah, I think NAIOP really is on the forefront of all of that on behalf of all of us and the entire development community, as far as working with the municipalities and those building departments. I think it's great. Jamie's got her hands full. I applaud you. Good luck. Did government affairs for a few years, way back, but whew, it's a lot. Anyway, so Alex, you are working out of multiple markets. How is Las Vegas competing with Phoenix, Salt Lake? How are we competing? How do we look from an outside perspective looking in?
Wow. All right.
That
90
wasn't on my
seconds, you
list of
said?
questions.
Yeah, 90 seconds. All right. Las Vegas is doing well. I talked at the top about just the metrics, right? Those are strong. The vacancy rate's half of what other large markets are. That's great. The trends that we look at, the trends that we're looking at now for this new construction, this new office building, there are 4. So let me see if I can remember all 4. The first is we look at new construction. We look at new construction. The first 2 are relatively intuitive. We look at new construction. We look at what the pre-leasing is of new construction. Is this just building because paper's cheap, you can borrow easy, you got to build something, you can get good loans, good terms on construction loans. If it is, then that's not necessarily doesn't portray the true macroeconomic factors. So the first thing we look at is that new construction, pre-leasing of new construction. Second thing that we look at is, weirdly, sublease availability rate in Class A. How strong is Class A actually? Are people just leasing it and then like, we don't really need the space, and then subleasing it? So looking at that sublease availability rate in Class A here in Las Vegas is very low. That's great. Third, we look at migratory patterns. I know I chatted with you guys a lot about this. Understanding where people are coming from, why people are coming to Southern Nevada. As you all know, you can't have a real estate, session without a quick bash on California. People are coming from California. It continues to happen. We're the beneficiary of that. So understanding those migratory patterns, understanding the cross-border migration of companies is very important. You start to see these companies that are leaving states with high taxes, with lots of regulation. You look at yesterday's news, Palantir moved out of New York City to Florida. You start to see some of these, you look at this cross-border migration. Unfortunately, we're at about a 10-year low on cross-border migration. We don't know exactly why that is, but Southern Nevada, again, when you just look at kind of like driver license turnovers, continues to perform with people coming from Southern California. So new construction, sublease availability, migratory. Okay, so then in Southern Nevada, in Las Vegas is if you think about like the general trends of hub and spoke models, Las Vegas is generally in the Class A office market a spoke market. It's a market where your financial institution, your professional services firms will set up a hub. So understanding kind of that bedrock of the professional services firms within Las Vegas is really important. And then looking at those companies, the financial institutions, the law firm, AM 100 law firms, understanding if they're growing or contracting. We've been fortunate enough that this makes up a large proportion of our tenant mix. They're all growing. That's very positive when you look at it from an office market perspective. If you start at Class A and then start kind of kicking down into other classes, that is a very good sign for the market. And all of our financial institutions, all of our law firms are growing, are wanting new space. That's only one reason people are coming here.
So you're going to bring that Rosemary building out of the ground a little sooner? than Q1 29?
They love it when the leasing guy talks. The development team's probably ready to kill me right now. Yeah, absolutely. Whatever that time frame was, yeah.
Thanks.
I think we're breaking ground tomorrow, right, guys?
What's the Rosemary building?
So it's 160. Thank you very much for asking,
Yes.
Rod. Yeah.
I was trying to get him to talk about it.
This is great. We've designed a 150,000 square foot Class A office building adjacent to 1700 in downtown Summerlin. Working
Which
with
one's 1700?
1700
Big
has
white
wind
one.
design on
Big
the top.
white
of it. Yeah, all right,
Just
thank
south.
you. Yeah, we're working with Architectonica on it, so it's going to be another spectacular building. Don't believe the renderings you see in CoStar, but we will put new renderings up very soon. I want to do it. Well, they got to keep the leasing guy in his lane.
And how is retail happening or working out at downtown Summerlin? Now it's getting a little older.
I love this. I love this. I'm not
Come on.
staying in my lane. I love it.
Just a little bit. Just a little bit. Well, we got you here.
Yeah, can we black out this part when you have the recording so that no one in the company sees it? Retail is doing really well, right? We've come through our first iteration of leases. Now we're looking at the rollover. We're upgrading all of the tenant mix from kind of the Gen 1. We're on Gen 2 now. A perfect example is that in this same category, exactly the same category of apparel, you look at two different companies that have basically the same amount of square footage. One of them signed 5 years ago, has escalations every 5 years. We then just signed one end of last year. The one that we signed end of last year on a comparative basis is over 20% higher than where that other tenant escalated. So you just look at that over a couple of years, same category, same size space, everything's very, very comparative except for rate, which is over 20% more. So the health of downtown Summerlin it's good right now. God, I'm so optimistic right now.
I love it.
Everything's
I
good,
love
guys.
it.
Nothing
It's
to see
good.
here. Everything's great. Yeah.
I think that goes back to Andrew's conversation or comment about the K economy, and you can just look at downtown Summerlin and see how the tenants that they've rolled out and the new tenants that they've brought in, they're really catering more to that high end.
Yep.
So they've taken away from the middle. Not that that's bad. You guys are doing what you need to do to maximize your portfolio.
I will say it is a diverse tenant mix. So
Yeah.
we aren't just focusing on that.
I understand, yeah.
And partly because of what Andrew said, is that there's such a broad sector of demand right there that you have to accommodate that. And we are fortunate that we own a lot of stuff, so we're able to do that and are not just trying to achieve 38% IRRs.
Yeah, you guys got how many acres of land do you guys have left? 4,000 acres or something like that? Yeah, you're good.
All right, you guys, I am going to turn this over to Dan. Hopefully we've got some questions. Where did Dan go?
You can
There he
keep
is,
going,
in the back.
Suzette. You can keep going.
Ruth has a question here.
You have
Up
to
front.
send it to me on a piece of paper.
She's got it. It's ready
Where
to
is it?
go.
There
Right
you
up
go.
here.
The one question I do want to ask is,
Yes.
are you guys speccing out anything?
Specking out office?
Yeah, speccing out any office, or I know
So-
are you speccing out your office?
We never have. In my 32 years here, I've never specced out office, predominantly because we try to design very flexible buildings and don't know what the sizes are going to be, and we've got multiple office entries and have just found that the marketplace is such that we haven't needed to do that. We've got our current project has, for the first time, 3 single-tenant buildings. We will be at least permitting spec offices for that. I think you get it teed up and ready to go. Maybe if building department allows us to get an underground inspection, do the plumbing on it, but otherwise, it's risky to build out spec office. And oftentimes, the tenants that need to be in that quickly, you may not actually want them long-term. How about you?
For retail, no way. For some of the spec office on the shallow base stuff and some of the small base stuff, targeting that 5 to 15,000 suites, yeah, we're doing that. But more of kind of a diverse mix where you can, kind of what you're saying, it's like a flexible office kind of design, or we'll spec out a couple, but we'll do all the undergrounds for everything else, I think, and we're doing that more in Phoenix. Mm-hmm. And then we're just doing a small, 10% or office up in, 3,000 feet office in our 300. So, but yeah, just kind of that speed to market, more or less, because I don't want to wait 90 to 120 days for an approval, and then another 90-day kind of build out, more or less.
Yeah, I think, but if you've got permit in hand,
That's exactly right. So
Yeah.
go do the permit ahead of time, maybe do a modification, and then you can do it. Or at least do the undergrounds is what we'd kind of
if you can do a modification.
That's right.
Andrew, on Warm Springs and Bermuda, you guys just
Bernardo, yeah.
or Bernardo. You guys
Yeah.
call it Bernardo.
Yeah,
That's so
Bernardo
funny.
Springs. Is that
Bernardo
one?
Springs. Yeah.
Yeah.
You guys are putting a new face on it, putting some lipstick and rouge on it,
Yeah.
making it look really nice and sharp. It was kind of dilapidated there for a while.
Yeah.
How are you re-tenanting that? What is your strategic game plan on repositioning and re-tenanting that building?
Yeah, so that's more of kind of our bread and butter. So we just kind of bought, she's referencing like a 24,000 foot strip center. It was like 70% occupied when we bought it. It's now like 80. We renewed 6 of the tenants. Kind of to your point on talking about some of these rents, like they were at like $12 to $15 and we're easily hitting 24 on a triple net basis. Or some of these leases are modified gross or they're gross leases and we're converting them to triple net. We just bought a neighborhood center, 145,000 feet. It had a vacant Rite Aid. So the Rite Aid was going through bankruptcy in like a 40,000 foot space. It's a shadow anchor to an Albertsons. Just signed an LOI with a fitness user. So I think what's backfilling these box spaces is like, again, to that experiential, but we're seeing gyms and fitness really take a big push into these box spaces. And the gyms like EOS, Planet Fitness, LVAC, I think Fit Club just signed a lease off Eastern. That's where you're seeing backfilling these boxes. But you need an activator of traffic, and that's kind of what we're looking at. But yeah, do a facade lift, give like a modest TI allowance, but we really focus on the tenants inside our space first because we think those are the low-hanging fruit.
Yeah.
And then we say, hey, let's keep improving the center, parking lot, roof, mechanicals, facade striping, just kind of give tenants pride in their space of what we're doing over there. So yeah, just kind of more or less the Class B tenants that we're trying to target.
Great. Dan, back to you.
Alex, can you explain your real estate term sandbagging for the...
Oh, yeah. Keith, where are you? There you are, yeah. It's a sales, absolutely, yeah. I would just say, I hope that's a joke, but I would just say it goes to the point of how much activity we have. When we track our activity, we view it as a leadership team every single week. And it's unbelievable how much more activity we have in the past 30 to 45 days. Keitha, right? 30 to 45 days? Yeah. Than we did at the end of last year. Usually it's like that mad dash at the end of the year. This has been a mad dash at the start of the year, so buckle up, Keitha.
And Dan, everybody sandbags when they do their budget.
Yeah.
Andrew, what is your term for expensive money?
High octane?
Yes.
High octane capital? Yeah, no, I know you're waiting for that one.
High octane.
So we have a question here for Andrew. You said it's it's what's trending? What's the big word that goes? Bifurcating?
Yeah, bifurcating within the K economy.
K
Yeah.
economy.
How do you see the difference between experiential and per demographics? Per neighborhood demographics is the question.
I think it kind of goes back to that comment, like when you look at Chinatown, like as an example on demographics, it's kind of ironic, like when we go to Phoenix or Reno or a lot of other places in bigger metros, they don't have a Chinatown like ours. And Chinatown has some of the highest rents per foot in our overall retail market. And some of these properties are, 50 years old that have been repositioned. And I think it kind of goes into where's your neighborhood? Las Vegas has coined the term Ninth Island for Hawaii. We have a pretty big Hawaiian population. We have a huge Filipino population. Like I said, I think a third of our market's, Hispanic, Latin-oriented. So I think you just kind of have to really look at your neighborhood and look at those demographics. Like in that Warm Springs Center, we have like a 3,000-foot Indian market. And we're like, are these guys going to stay or are they going to go? And then when we kind of asked around to some of our neighbors or some of the people in that community, they're like, no, that's a staple in the neighborhood. So play on those neighborhood staples, lean into those demographics. Don't try to, put a square peg in a round hole more or less. But I think you're just, again, going back to your point, where retail rents have really gone, also kind of the build out of these spaces. I don't know what you're doing on that kind of lease. What we're seeing is the affluent tenants or the upper scale brands, maybe to what you're saying, is like when I was kind of going about the occupancy costs, is they're able to pay more because they can charge more. And I think even when we're talking about restaurant space, I don't know how many people in here go out to eat a lot. I like food, so I go out a decent chunk. When you try to get a high-end reservation at a restaurant, it's pretty hard throughout the entire week. But then you see some restaurants that are just completely empty on the same account. So I think what we're seeing is, again, higher scale because the affluent has more discretionary money to kind of go into that space. And I think you're going to see cap rates rise for the C stuff. And then to more of your point earlier on the delinquencies, you are kind of see like those workarounds and on the lower end of the spectrum. You can't push those rents that high. So again, talking about what the rents he's probably getting at downtown Summerlin, $60, $70 a foot, whereas Warm Springs, I'm just trying to get 24. So I think that's kind of the really big delta there.
Yeah. Do you think there's a segment of the market that in the next, 18 months to 2 years is going to really outperform? Do you guys see any really bright shining stars
Just
here
overall?
in Southern Nevada? Yeah, overall.
New construction, Class A office.
Yes.
Office condos.
Office, yeah.
Office condos, yep. We didn't get into that, but that's a big thing. So.
Yeah.
I think you're going to continue to see some more advanced manufacturing come to Vegas, both from California. Interestingly, we've seen a lot of interest lately from Washington. I think state government in Washington is patterning themselves after California, so we're seeing more of those companies now, at least evaluating Vegas.
Yeah.
Real quick, how important is power to you guys on these buildings that you're
Extremely.
developing?
Extreme, particularly when you get to advanced manufacturing. I don't know at the end of the day, and I see NV Energy here, we get inquiries all the time, I need 4,000 amps of power. And they'll do their calculated load and think that they come up with it. And then whenever we ask for what their peak demand is in an existing location, it's a fraction of what they think they need. But nonetheless, if that's what they think they need, that's what you have to put into your buildings. And it's definitely, higher priority now than it's ever been before.
Yeah.
We've got, Dan, do you have more?
I know all of you thought that I paid Rod Martin off for that great plug. And there could be nothing farther from the truth. He's an honest man. I offered him, and he wouldn't take the money. We have Caitlin Farr here from UNLV. She's going to tell us what her major is and what she's doing, and she's going to ask all three of you a question. So Thank you very much, and then we're going to end it.
So I'm Caitlin Farr. I'm a real estate and finance major at UNLV with a minor in psychology. I'm currently an intern at Sun Property Management. So I am one of the students, UNLV real estate students in attendance today, and I was wondering if you were starting your development career today, what would you focus on learning first, and what advice would you give us?
You?
Sure. Oh, boy.
We have 4 minutes.
Okay. Focus on yourself, recognize where your strengths and attributes are, and really leverage those. If you happen to have family in the business, nepotism is the best way to get into the business.
Yeah.
That's difficult. If you go to a service academy, that's probably the next best thing. If you don't have that, it's really understand what your own strengths are. Broaden your foundation. Unless you're somebody with a genius 160 IQ, you're just going to have to work really hard. You're going to have to work hard. You're going to have to have a reputation where people like you and trust you. If people like you, they want to help you. Don't get frustrated. It's going to take a long time and a lot longer than you might like. And you think, my gosh, I don't have a job, my next job, whatever it may be. I'm miserable in the job that I'm in now. You're young. Just don't worry about it. Don't stress. And it will all work out. And people want to see you succeed.
Yeah. That's great. Great advice. Alex, starting out in the business, what would you do?
All right. Oh, boy. It is a fun question to think back of all your mistakes. Okay, so first thing I would say is the easiest advice to give is often the hardest advice to get, which is just be patient. So I offer that to some of the young people that work for me all the time, is that just be patient. It's really hard to hear that, but it's true. The second thing I'd say is hang around the hoop. It's amazing. These two guys, I think, will totally agree with this comment. If you're just working hard and if you're just hanging around the hoop, things are going to happen. I can assure you that. If it doesn't, continue to be patient. Then third, if you're moving to if you're staying in Las Vegas, that's wonderful. This is a fascinating economy, and it's a fascinating real estate market. I get to see a lot of real estate markets in my job, and this is one of the most exciting right now. It truly is. The diversification in this market is extraordinary, what's happening right now. If you move to another market, be a tenant rep broker for a year. You'll know every building, you'll know every tenant, and you'll know every landlord.
I'd echo the long game. You got to play the long game. And I think if you're a social kind of person, go join a brokerage, get on the leasing team. I think the founder of Trammell Crow said it best. He'd only hire ex-leasing people. You want that transaction volume. You want to understand what tenants are looking for, because it helps you be a better landlord and a better developer. And then on the other side, if you're not a socialite and you don't like hitting the phones and showing up to meetings and being personable, go be an Excel jockey for a capital markets firm and go understand what the money wants, where's the money moving, the different types of money, different types of equity, debt, banks, debt funds, kind of everything, and that's going to help you get that transactional experience. But again, echo the long game.
Great. Thank you guys so much. This was
you.
so fun. You made it easy for me, and thank you for that.
Thank
and
you.
thank you to the audience. A lot of fun. All right. Thank you, everybody.
What a great panel. Thank you again to our speakers and our program sponsor, Schnitzer Properties. And thank you to all of you for attending this meeting this morning. We hope to see you at the March breakfast program here at the Orleans on Thursday, March 19. There's a great day out there somewhere. Go get it. Thank you.